Hey, this is Andy with another Damp Spring Explainer. Today's topic is about auctions. We just had a 20-year bond auction and I graded it a D. And people want to know why I do that and what are the grades about. So here's the short and sweet. So every few days, well, pretty much every day, the government auctions something. At 1 o'clock, three times a month, a week on some weeks, and just once on other weeks. Depends on a schedule. The government auctions long duration Treasury bonds, from 2-year notes to 30-year bonds to TIPS, Treasury inflation protected bonds, across the entire yield curve, and they do it one by one, and a lot of 2-year notes and less as you get out the curve. But they're trying to establish they schedule these auctions to have a consistent and regular supply of duration for investors. So when it comes to the auctions, the way the auctions work is at 1 o'clock, you have to submit your bid. Most people submit their bid before that, but and the bids can take many different forms. And I'm not going to get into the minutia of that. I'm just going to get into the what I care about in terms of grading an auction, and then I'll follow up with why I bother and what it might mean instantaneously, and what it might mean for assets over a longer horizon than, say, for the day. So let's start with grading. So what I'm trying to assess in the grade is how much demand there was for the auction. And there's a lot of ways you can do that. Let's start with price first. If a new bond that has been auctioned, that's never been auctioned before, that doesn't actually even exist yet, is auctioned. That's one type of auction. It's called auctioning what is defined as a when issued security prior to the auction. The other type of auction is a what is it called? Reopening, RO, a reopening auction, and that's when an existing bond, say they want to issue a 30-year bond, but they issued a 30-year bond, 3 months ago, and now it's a 29 3/4 year bond, and they're like, forget it. We'll just issue more of that one instead of creating a new one. And people don't really care. And so they reopen that auction and sell more bonds and collect money. So those are the two types of things that are auctioned. But in both cases, even the bond that doesn't exist, the so-called when issued bond, that bond actually trades for a few days prior to the auction. And you can buy and sell it. It doesn't settle until after the auction when it physically exists. But you can buy it today, before the auction. You can sell it before the auction and make money doing that trade. You just don't get paid until all of the trades settle when the bond physically exists. So the point being that both the reopening bond, if that's the type of auction it is, or the when issued bond, if that's the type of auction it is, trade in the market prior to the auction. And so you can look at that and say, okay, it's got a price. Well, the auction should reflect the fact that it's got a price. So say, for instance, the current 20-year bond had a yield. I don't even know whether it was a reopening or a when issued, but it doesn't matter. The auction bond that we're auctioning was yielding around 397 moments at the moment the auction closed. And so if you're thinking about that and you say, hey, I want to buy some of that bond, you submit a bid for a yield that you think will win the auction, or that you'll participate in the auction. If you really want to win, you might bid a yield of 390 because that implies a very high price, lower yield, higher price. Or you might even put a non-competitive bid in which you get it at whatever the price is. So there are lots of ways, and again, I'm not going to get into that. The bottom line is we can assess the demand based on the price before. So one of my parameters, and I've got 5, one of my parameters is the difference between the when issued, the 1 o'clock price and the price that the auction actually gets done at. So for instance, if it's a 397 the moment before the auction and the auction clears at 395, which means demand was strong and they bid up to get filled, that's for that parameter, I'd give that an A. If it's 397 and the moment before the issue and it tails to 4%, that means there wasn't a lot of demand at 397 when they actually auctioned the bonds, and its clearing price was 4, and so that would be on the other side, a D. I rank them from A plus to D minus. I do have an F ranking, but the US has never had an F auction. That would be an auction that literally doesn't clear. That hasn't happened. So anyway, that's the scale. And then each of the various parameters I consider are also important. So let's look at some of those. The first one I consider is the indirect bids. And I'm going to share my screen to show you how indirects have worked over time. Yeah. Let's see if this works. Okay, yeah. So there's my Bloomberg screen, and as you can see, this is the historic indirects. And you notice indirects have been very high in 2022, but this auction, it wasn't quite as high as it's been. And so I thought, it's not great. I'm going to give that a below passing grade. You could decide whether that's a big indirect or not. I thought it was, we've been seeing indirects that have been very high. And this one was a little less high than the last auction, so I gave it a below passing grade, C. So what is an indirect bid? Well, an indirect bid is literally a bid that was sent by a broker-dealer as an agent to the Treasury. And that means the customer, for some reason, is unable or unwilling to participate directly in the auction with the US Treasury, and just doesn't have the middleman of the broker, the primary dealer. Typically, who those are foreigners. And often we care a lot about foreign demand for our Treasury securities because they may have non-economic reasons managing their currency, for one, and they can see central bank participation in that indirect flow. And so indirects being very strong is generally it means foreigners are are using US dollars to buy US dollar assets, and so is a good auction, one that's showing liquidity, has a high indirect. And as you can see, lately, even throughout 2022, the indirects have been strong. 20 years a weird bond. I probably should have used a different auction, but this is the one they did today, so we're going to look at that. The next topic is the bid to cover. And the bid to cover was bad in this auction. As you can see, way below the last auction and pretty much below what we've seen for a while now. What is the bid to cover? That's essentially the amount of bonds that would have bought bonds at the price that they traded. Okay, so that means there was more demand than they actually had at that particular yield by 2.5 times. Well, that's, the higher that number is, the more demand there is at the yield. So you're looking for a high number for a good grade. And so I rank that it's high relative to longer history, but I still rank that a D. And again, you can see this is me just using some data, but mostly just guessing. So take it for what it is. It's just me doing it. You could systemize it, and I'm sure people do. I'm sure algos do. And scrape the data and know what the grade is and do what they do. But I'm just a guy. Okay, so what are the other things I care about? I mentioned indirects. So this is directs. This is usually a small number, and it's sort of U.S. institutions who are buying bonds. And this number has been small for a while, and it's pretty small. It was a little better. I'd see it sort of a little below the long-term average. So I'd say not a lot of direct participation. So I'm going to rank that below a C, below passing. What's left, by the way, you notice 18 was this one, and 75 was the other one. What's left is dealers. They're the third participant, and you really want them to be as small a participant as possible, because if the dealers have to take up the bonds, you know, they're not long-term holders. They're trying to hedge those bonds immediately upon receiving them, or sell them to a customer, or they don't represent sort of real risk-taking demand. Maybe temporarily, but not for the long term. So you generally want that number low. I don't consider it because I look at these two, and this plus the other one equal minus 100 is the dealer. So it's in there, but this grade was below average. And then I guess the last thing I mentioned the difference between the when issued price and the actual auction price is important to me. I also care a lot about the aftermarket trading. And so if you notice, the auction happened at 1. You notice all day. Now, there were other reasons why the Treasury market was down. I'm using TLT because it's around a 20-year. You could actually use the physical bond, but I didn't want to go find it. So here's what you got. So you notice that it's the same. So the TLT was down for pretty much all day for a variety of reasons. One of which was that there was 15 billion of 20-year notes being issued, and 20-year notes are in the TLT. So looks like people were saying, "Gosh, there are a bunch of 20-year bonds coming," but that sort of stopped around here, and people bid them up, and then the auction happened, and the aftermarket's been bad. So I would rate that a D. So you add all those things up, you got those 5 things, I give it a D. Now, why do I care? Well, that's a good question. It may not make much difference. What I've seen, and I have my own way of systemizing my grades and then evaluating whether it has a leading relationship to asset prices. It's up to you to figure out if you can find a relationship. I think there is one. And in particular, there's a short-term action. For one, it would be nice to be able to grade the thing before it happens. Like if you can predict the grade, then you might be able to, catch this. If you knew it was going to be a D, you might have been shorting here. But that's not my objective. My objective is to, get the information when it comes out and then project what's going to happen. And, a D meant, you want to sell here, you want to sell here. But if you sold here, you sold too much. So, short term, there might be a play. Now, also, it might have an impact on other asset prices. And so what I look at is usually it has to be an extremely bad or extremely good auction to then flow through to the S&P, for instance. And it's up to you to see those things, but the A+ auctions generally end up meaning that there's quite a bit of demand for financial assets and animal spirits are strong. And even though being bullish on bonds is not necessarily bullish on stocks, when liquidity is showing up to buy a bunch of bonds, there's a fairly good chance that you want to buy other assets. So go ahead. And you check. A+ auctions tend to lead equity positive returns, and D- auctions tend to lead, and we're talking about day trades. D- auctions tend to lead negative S&P returns. So that's why I do it. I'm not a day trader though. So why else do I do it? And that's the big deal. In January, we had, I don't even know how many, maybe it was 10 A+ auctions in a row. And that tells me something. And it really told me a lot about, because the indirects of those A+ auctions were extraordinarily strong. And that tells me that the liquidity that's causing the January rally in financial assets is probably coming not from, sort of, QT is that as a hit to liquidity, and this is clearly a liquidity impulse. And so that makes me think, who is buying and where are they buying? And I think the answer is we're seeing it in the indirects, and that means there's some sort of foreign liquidity provider. I'll stop there because there's some, that's sort of my my proprietary interests. Oh, by the way, look at this D- auction continues to trade off. Anyway, that's that's why I do it. It's up to you to determine if there's any value in that, but I thought I'd share what I do. Have a good day.